Welcome to Global Equity Research from Softgate Capital Research. I'm Emily Carter, here with Gregory Palmer. If you enjoy the show, please like, share, and subscribe. And you can download the full report anytime at softgatecapitalresearch.com.
Thanks, Emily. Q2 2026 in the U.S. looks strong if you only read the headline numbers. But the deeper story is split, almost awkwardly split, between visible fiscal lift and underlying fragility. That's the key framing for this quarter.
So, on the surface, growth is holding up. Underneath, households and businesses are not experiencing the same economy at all.
Exactly. Consensus real GDP forecasts mostly sit around 2.1 to 2.2% year over year, with the Fed median at 2.4 and the CBO at 2.2. But that tidy range hides a much wider dispersion in views. Goldman Sachs is materially more upbeat, looking for 2.8% full-year growth and 2.5% in the fourth quarter. RBC, by contrast, is basically saying, careful, this may be a stagflation-light regime with growth running below the old trend rate.
And a big reason the data may feel better than the economy actually is the timing of the fiscal support.
Right. The OBA changed the fiscal map. It created a very large tax framework over the next decade. But what matters now is the near-term disbursement pattern. Several provisions were retroactive to the 2025 tax year. So between February and April 2026, you get a concentrated wave of cash hitting households. That includes the higher SALT deduction cap for households earning under $500,000, enhanced child tax credits, and exemptions for qualified tips and overtime that lifted take-home pay starting in January.
Which means Q2 gets a pretty direct consumption tailwind.
Yes, and JP Morgan maps that very clearly. They see an anemic first quarter, then a sharp acceleration to 3.0% annualized across the middle two quarters as tax refunds and tariff rebate checks hit. And then a slowdown later in the year as that impulse fades and higher financing costs bite again. It's a sugar rush, but a very targeted one.
Targeted is the right word. The report is pretty explicit that the benefits are skewed. Upper-income households and capital-intensive firms are getting the most immediate lift, while lower-income consumers are facing a much tougher backdrop.
That's the bifurcation. The same law that boosts liquidity for affluent households and supports corporate investment also tightens the social safety net. Medicaid and SNAP changes raise administrative hurdles and reduce support for vulnerable groups. So aggregate GDP can look healthier even while parts of the consumer base are getting squeezed harder. That's why the report calls it a kind of liquidity illusion.
And on the corporate side, bonus depreciation matters too. Companies can deduct the full cost of qualifying property much faster, which should help manufacturing reshoring and data center spending.
Absolutely. That's one reason the bullish camp thinks the U.S. can grow above consensus. Lower corporate tax rates remain in place, 100% bonus depreciation is accelerated, and AI-related CapEx is still powerful. But I keep coming back to this. Strong top-line growth in Q2 does not automatically mean a durable, broad-based expansion. It may just mean the fiscal wave arrived on schedule.
So if listeners take one thing from Chapter 1, it's this. The U.S. growth story is real, but it may be temporarily boosted and very unevenly distributed. If growth is the easy headline, inflation is still the hard part. Gregory, the report is pretty firm on that.
Yeah, and inflation models on air always make me tap the table a bit, so bear with me. The Fed's March projections moved PCE inflation up to 2.7% for 2026. And core PCE to the same 2.7%. That upward revision tells you disinflation has slowed meaningfully.
What keeps it sticky?
First, core services x housing. This is the stubborn center of the inflation story because it's tied closely to wages and labor intensity. Think healthcare, education, personal services, all the areas where labor is the product. RBC notes this category hasn't printed negative year over year in 4 decades, and with labor tightness still present, there just isn't much relief coming from that side.
And housing isn't giving the quick disinflation many people expected either.
Correct. Owner's equivalent rent is still pressing upward, partly because it lags real-time housing conditions by roughly 2 years. Home prices bottomed in 2023 and then moved higher through 2024 and 2025. So that lagged effect keeps OER from helping much in 2026.
Then there's tariffs, which sound simple politically but are messy economically.
Very messy. Goldman Sachs estimates tariff pass-through added about 0.5 percentage points to core inflation, mostly through goods. Their view is that this is largely a one-time price level adjustment that should fade out of year-over-year comparisons by late 2026. But the more cautious view, especially from RBC, is that the peak consumer impact arrives in Q2. In other words, the goods inflation story may feel worse before it feels better.
And just as that pass-through is landing, energy has become another problem.
Exactly. Conflict involving Iran disrupted energy markets and threatened shipping lanes, pushing WTI above $95 a barrel by mid-March, a roughly 40% month-to-date surge. Central banks usually try to look through commodity spikes, but when the shock is large enough and visible enough, it can bleed into freight, manufacturing, logistics, and consumer psychology.
That consumer psychology piece matters because expectations themselves can make inflation harder to contain.
That's the crux of it. The University of Michigan survey had year-ahead inflation expectations at 3.4%, still elevated relative to the pre-pandemic range. If households think prices will keep rising, they change behavior. Businesses do too. And gasoline prices matter disproportionately here, not just because they hit inflation math, but because they're a highly visible and regressive burden.
Especially for lower-income households, where fuel and essentials take up a larger share of the budget. A jump at the pump quickly crowds out dining, apparel, and discretionary purchases.
Yes, that's why headline gasoline can matter more than abstract core readings in the real economy. Lower-income consumers feel it instantly. So even if some forecasters like Vanguard or Goldman still see core inflation easing later this year, the path in Q2 looks sticky, noisy, and socially uneven. That makes inflation the hardest problem because it constrains policy just when parts of the economy are already weakening.
Let's bring it together with policy and markets. In March, the Fed held rates steady at 3.50% to 3.75%, and the tone was clearly not dovish.
Not at all. The March meeting was a hold, but it was a hawkish hold. The dot plot shifted to imply only 1 quarter-point cut in all of 2026, fewer than markets had been expecting, and the estimate of the longer-run neutral rate moved up to 3.1% from 3.0%. That says the Fed thinks the old zero-rate world is gone, or at least gone for now.
And the labor market softening wasn't enough to offset the inflation concerns.
Right. Policymakers explicitly pointed to the inflation risks from oil, tariffs, and supply disruption. Then comes the leadership transition. Jerome Powell is set to be succeeded in May 2026 by Kevin Warsh, and that is not a cosmetic change. Warsh's framework appears more structurally oriented, less fixation on every monthly data wobble, more focus on productivity, long-term inflation discipline, and the size of the Fed's balance sheet.
Which is where quantitative tightening becomes the market's story.
Exactly. Warsh has been openly critical of QE and is expected to favor a faster reduction in the Fed's securities holdings. If you pair lower short-end policy rates, potentially, with more aggressive QT, you get a setup for curve steepening. Short rates can drift down, while long-end yields stay pressured by term premium and heavier price discovery. For markets, that reshapes financial conditions in a very real way.
And a steeper curve is a very different environment from the inversion banks have been dealing with.
Yes, banks are the clearest relative beneficiary in the report. A steeper curve tends to help net interest margins, and Warsh is also aligned with a lighter touch regulatory posture. That combination is constructive for financial equities. Industrials and materials also have upside if domestic infrastructure, defense spending, and eventually a cleaner trade backdrop support demand.
But that cleaner trade backdrop is far from guaranteed, because the USMCA review hits on July 1st.
That's the binary event. The review was supposed to be administrative. Instead, it's turned into a high-stakes negotiation over rules of origin, labor requirements, and broader political issues. If the three countries fail to agree to extend the pact cleanly, you move into destabilizing annual reviews and a long countdown to potential expiration. Companies hate that kind of uncertainty.
So CapEx gets delayed.
Precisely. Auto, industrial machinery, agriculture, cross-border manufacturing, all of them hesitate when the tariff framework is in question. That can freeze nearshoring plans and weigh on capital spending even while tax policy is trying to encourage investment. It's a weird push-pull. For tech, the picture is still stronger because AI infrastructure spending remains a major earnings engine. But even there, rates, power constraints, and broader financial conditions still matter.
So the market takeaway is not just growth good or inflation bad. It's more nuanced. Banks may like curve steepening and deregulation. Industrials need trade clarity. And tech still has structural support, but has to navigate a less forgiving rate regime.
That's exactly it. Q2 2026 looks like a transition quarter, a fiscal boost in the foreground, inflation pressure in the middle, and a new central bank regime plus trade brinkmanship in the background. And that background may end up driving the next move more than the headline GDP print.
That's where we'll leave it for today. If you found this episode useful, please like, share, and subscribe, and download the full report at softgatecapitalresearch.com. Gregory, thanks.
Always a pleasure, Emily. We'll be back soon. Goodbye.
Goodbye. This publication has been prepared independently and impartially by Softgate Capital Research, a company based in the Czech Republic, for the sole purpose of providing general informational content. It is intended as an additional source of insight for interested readers, and may include general market commentary, macroeconomic observations, or descriptions of financial products, without any emphasis on marketing or product promotion. This document does not constitute a marketing communication within the meaning of applicable EU and Czech regulatory frameworks, including Delegated Regulation EU 2017/565. It contains no direct incentives to purchase financial instruments and is informational in nature. The publication does not provide investment recommendations, value judgments, or guidance regarding the relevance of the information to any investment decision. Accordingly, it does not qualify as investment research under Article 36, Paragraph 1 of Delegated Regulation EU 2017/565. It has not been prepared in accordance with legal requirements designed to ensure the independence of investment research, and is not subject to restrictions on trading prior to the dissemination of investment research. All information contained herein is non-binding and reflects the knowledge and understanding of the authors as of the date of preparation. Softgate Capital Research reserves the right to amend, update, or withdraw any part of this publication at any time without prior notice. Nothing in this publication should be interpreted as an offer, solicitation, recommendation, or invitation to engage in any transaction involving financial instruments or related products. No part of this document should be relied upon as the basis for entering into any contract or for including any financial instrument in an investment strategy. The information presented is derived from publicly available sources that Softgate Capital Research considers reliable. However, the firm has not independently verified such information. While reasonable care has been taken to ensure accuracy and fairness, Softgate Capital Research and its representatives make no express or implied warranty regarding the completeness, timeliness, or correctness of the content. No liability is accepted for any loss or damage, direct, indirect, consequential, or otherwise, arising from the use of or reliance on this publication. Hyperlinks to external websites may be included for reference. The presence of such links does not imply endorsement, approval, or responsibility for the content of any external site. Any opinions, estimates, forecasts, or projections expressed herein represent the judgment of the authors at the time of publication and may change without notice. Softgate Capital Research has no obligation to update or revise this document should circumstances, assumptions, or market conditions change. Past performance of financial instruments or issuers is not indicative of future results. No assurance can be given that any financial instrument or issuer discussed herein will achieve favorable outcomes or reach any particular price level. Forecasts are based on assumptions supported by available data but remain inherently uncertain. Softgate Capital Research, its principals, or its employees may hold positions in or engage in transactions involving financial instruments mentioned in this publication. The firm may also provide services to issuers or companies referenced herein. Softgate Capital Research may act upon information contained in this publication prior to its distribution. This publication is the intellectual property of Softgate Capital Research and may not be reproduced, distributed, or transmitted, whether in whole or in part, to unauthorized recipients without prior written consent. By accessing this publication, the recipient agrees to comply with these restrictions. Softgate Capital Research is not registered or certified as a credit rating agency under Regulation EC number 1060/2009 on credit rating agencies. Any assessment of issuer creditworthiness contained herein does not constitute a credit rating within the meaning of that regulation. Analyses or interpretations of credit ratings are based solely on publicly available rating documents and do not represent a rating action.